the best of Money Matters.
Market View on Money FM 89.3.
You're listening to Money FM 89.3. It's time now for Market View, and I'm Nadiah Koh. The SDI closed down at 0.4% at 4,456 points. On the local front, DBS hit a new record high, pushing its market capitalization past 150 billion Singapore dollars. Meanwhile, Keppel REIT is taking a bold step into the retail market, announcing the acquisition of a 75% stake in Sydney's top Ryde city shopping centre for about 394 million Australian dollars. And on the currency front, the Singapore dollar has strengthened to its highest level against the Japanese yen in over a year. And turning to Japan, real wages fell for the 8th consecutive month in August, a trend that has important implications for consumer-focused sectors and investor strategies. So for more market insights, we are joined by Kenneth Goh, Director and Private Wealth Management at UOB Kay Hian. Hi Kenneth, happy Hump Day.
Hi, thank you for having me today.
Thank you for joining us. So there's a lot to unpack, but the STI opened at 4,468 points. What's your take on the movement so far?
Generally speaking, it has half of the winners and half the losers, laggards rather, pretty much equalize each other from there. You have, as of 4:36 p.m., then the breakdown would be Sembcorp Industries was about 1.26, Wilmer it's 1.05, Thai Beverage at 1.05. The laggards was, equalized by Yang Zijiang at negative 2.56, Jardine Matheson at minus 2.15, Genting at 1.38, DBS at negative 0.71%. Generally speaking, the market is just taking a wait-and-see approach. So hence, you would see the SDI just taking a pretty much a sideways trending pattern as of today, as you have indicated just now.
So Kenneth, looking at banking stocks, DBS hit a new record high this week, lifting its market capitalization past 150 billion Singapore dollars. That's double of its nearest rival, OCBC. So analysts are saying that the bank offers investors growth, safety and income. What's driving DBS' strong run? And at these levels, do you think there's still upside left for investors?
Valuations have DBS right now, for bank stocks, normally they view through two key matrices. One, of course, would be the PE rate, price-earning ratio. As of this present moment, DBS is 13.6, OCBC is at 10.3, UOB is also at about 10.3. Then you see that the price to book for DBS is at 2.24, OCBC is at 1.25, UOB at 1.24. So what is the market is saying is that, right, they view that DBS has a higher propensity to actually exceed its ability to extend and grow its earnings compared to its competitors from there. And that's why on a valuation basis, it is quite rare for the local banks to actually exceed 2. In this particular case, it has been doing so quite consistently as well. Right now, the market is viewing it as a place where it's embracing technology. It is seen as a place where it is growing its wealth management franchise quite aggressively as well. So that's why the market has actually priced in the higher PE and the higher price to book as well.
So Kenneth, do you see DBS Bank's performance as a reflection of broader strength in Singapore's banking sector? Or is this just a rally more about DBS's unique fundamentals?
Clearly, I would say it's a mix of both. One is obviously the CEO was, of course, recently highlighted as a Fortune most powerful person in Asia. And you also see that it's also an extremely well-run franchise itself. But the Singapore banks also, both OCBC as well as UOB, have extremely well-known franchises. They, for example, in the case OCBC, they have very strong presence in Hong Kong through OCBC Wing Hang. And of course, they have holdings in Ningbo Wing Hang in China. UOB, of course, 2 years ago, did massive acquisition of Citibank's retail banking assets of Southeast Asia itself. So each of the banks have their own unique strengths and its own unique capabilities, and they are highly rated by the rating agencies as well. Needless to say, the very strong interest in the Singapore stock market has also pushed them up as well because of the fact that these are seen as very safe and stable companies as well at the same time. All three are.
So, Kenneth, let's take a look at Keppel REIT. The trust announced it's acquiring a 75% stake in Sydney's top Ryde city shopping centre for about 334.9 million Sing dollars, making its first step into retail assets after years of focusing on prime offices. So, what's your take on this diversification?
Most analysts right now view it as a way for it to actually diversify it across its business. Because this property is currently anchored by tenants such as very famous tenants such as Audi, Big W, Coles, Kmart, Woolworths, right? It basically allows them to actually grow in view of the limited, and because in the sector itself, right, there isn't much of a growth, relatively slower growth as well from there. So the word that some analysts use actually has been, and I quote Morningstar on this one, inorganic growth. So in this particular case, organic growth refers to expansion through means such as acquisitions and property development rather than increasing rent occupancy in existing property. So in this particular case, they view it as one of the most pragmatic ways to actually grow it from there. It's a logical diversification because suburban retail malls is resilient. The key is, of course, through the tenant mix and managing the FX risk in Australia itself, because obviously the Australian dollar actually has performed significantly badly against the Sing dollar as well. So if they report the earnings in Sing dollars, there's something to be a little bit mindful from there. That's something that, even though retail may bring a bit of a higher volatility compared to, say, prime offices, because you wouldn't want to move to office like every 6 months or so, right? But if done correctly and done appropriately, it can help to actually stabilize the REIT's long-term income. But investors obviously should want to look out for the occupancy and the rent growth carefully from there.
Right. So, Kenneth, still in Singapore, the Singapore dollar hit its strongest level against the Japanese yen in more than a year, around 117.78 this week. It's also been holding steady against the US dollar, even as most Asian currencies have weakened. So what's supporting the Sing dollar right now? Is it the MAS policy or just weakness elsewhere?
The MAS policy framework focuses on keeping the Singapore dollar firm, and the stability makes Singapore assets much more attractive to longer-term investors as well. So naturally, this is something that it helps them feel a little bit much more comfortable about this thing, because political issues that affect the Southeast Asian region clearly is not a significant issue within Singapore itself. So on the other hand, speaking in terms of the Japanese economy itself, there's been issues of policy divergence, fiscal worries, and previously the Japanese yen was a very famous adverse trade, safe haven kind of trade, right? So people normally will swing into the Japanese yen as safe haven trade, as well as carry trades back in the day. But today, Sing dollar continues to do better relative to the Japanese yen due to its AAA rating and its safe haven status, and people actually view it as a place where, in the near term, at least Singapore should do well. However, in the medium term, if we view it as the medium path points towards a slow and gradual yen recovery and the lower Sing dollar to Japanese Sing to yen levels as the monetary divergence occurs, especially when tightening resumes in 2026 and the Fed easing deepens. But right now, in the near term, Sing dollar appears to be doing relatively much more better compared to the Japanese yen itself.
Right. So on that note, could we see increased inflows into Singapore equities and bonds because of the currency stability?
There's been, a very strong mandate, or rather a very strong focus in terms of getting the Singapore stock market by MAS to actually grow from there. Needless to say, because of the stability of the Sing dollar and it's seen as a safe haven currency, generally speaking, all things remaining constant, the market is much more positive in that respect. However, the another thing would be what are the names that will be there that's outside the big 30, right? Or generally speaking, you will see the levels of the other companies possibly actually absorbing a lot of capital from there unless there's new issuance starting to come out in the Singapore stock market.
Right. So should investors hedge foreign currency exposure now or ride out the current trend?
The truth is that if you are looking in terms of assets, bulk of the assets right now, the stock market interest right now is actually the US stock market, right? So like it or not, if you were to buy US shares, naturally there will be a lot of strong exposures to the US dollars from there. So investors have been hedging, and in fact our CIO actually have been looking in terms of the broad theme is of course de-dollarization towards AI, but ultimately it's looking towards more trying to, there's no way to avoid it in that sense. What you need to do is to hedge your bets. So you need to have a range of assets that kind of like hedge against the fact that the US dollar, the potential drop of the US dollars will be there. For example, investors are looking to asset classes such as gold, to hedge the bets of a potential drop in the fall of the US dollars from there. The Sing dollars, in that sense, if you were to go all in, also comes with its own set of challenges as well, because the stock market is relatively smaller compared to, say, Hong Kong. or compared to, say, the US itself. So generally speaking, investors, even local investors for that matter, would have exposure or indirect exposure, direct or indirect exposure to both the US as well as Hong Kong dollar because of these things from there.
So I want to turn away from Singapore to take a look at Japan right now. Real wages fell for the 8th straight month in August, highlighting the squeeze on household purchasing power even as inflation remains elevated. So how should investors view Japanese consumer stocks given the ongoing squeeze on real wages?
Extremely challenging. Japanese equities, because it's also a confidence issue, right? When real wages start to go down and inflation starts to go up from there, your real net income actually drops as a result from there. So what happens, right, is that if you're looking in terms of like domestic consumption, perhaps one investors would be want to look at in terms of the exporters, which a weaker yen actually benefits them, as well as tourism plays from there. So that allows, because exporters gain from the weaker yen from there. As of this present moment of time, anything that's too strongly domestic focused would not be something would be very ideal, especially when consumer confidence is relatively weak. And you would see that because most companies actually pay summer bonuses to their workers in June and July. So in this particular case, the August special tally tends to be a bit more volatile from there. But while interest rates are unchanged, as of last month, I think BOJ, Bank of Japan officials, have often repeated that wage hike trends would continue at the towards next year, and the impact of the US tariffs on Japanese businesses makes things very uncertain from there. So it makes things a little bit more challenging, especially domestically focused companies.
And are there any sectors that could benefit despite weaker household spending? What should investors be looking out for then?
Generally would be exporters. So when the yen is relatively cheaper from there, that makes Japanese goods relatively more attractive from there. But it's also the challenge, especially when the US tariffs come into the picture from there. Because the second biggest trading partner that Japan has is obviously the USA from there. So that's why the Japanese exporters would be a much more better bet, because it makes their goods relatively cheaper, at least in the near term. But that's why it's a little bit, I would say that confidence levels need to be a little bit higher before one would be a bit more gung-ho towards the Japanese equity market.
Right. And Kenneth, before we let you go, what else will you be monitoring in the days ahead?
Generally speaking, the market is looking at US inflation, Fed commentary, as well as China's golden week consumption and local banks' earnings momentum. I spoke just now a little bit about in terms of the dollarization to AI. We have been looking in terms of safe haven and the interest rate cycles from there. I think clearly, just talk a little bit about the US inflation and the Fed commentary. The Kansas City Fed chairman, Jeff Schmidt, said that the Fed needs to continue pressing against inflation that remains stubbornly high. And other Fed presidents are also saying that any drastic cuts to interest rates would risk striking inflation from there. So the ongoing shutdown right now, the federal government is going through a shutdown right now, right? And it's a little bit of a bearish for the US dollars as it enters the second week, right? So the longer the shutdown is maintained, the more likely that the US economy will suffer. Generally speaking, because federal workers are on furlough, so they got no job, they got no salary. It's not going to be really a very good situation from there. So inflation is still a little bit toppish. So the Jeff Schmidt said that monetary policy should lean towards demand growth to allow the space to supply to grow and relieve the price pressures in the economy. However, having said that, there has been pressures from the federal government to actually lower interest rates as well. So that these are the data, even though the Fed are data dependent to make interest rates decisions. However, much of the data, including labor statistics, for example, also as of this present moment, is not available right now due to the current government shutdown from there. So this is going to be a little bit more challenging from there. For the China market, the key thing is about the Golden Week. So that's why retail sales actually rose about 3.3% in the first 4 days of the Golden Week itself. And Hong Kong and Macau are receiving more Golden Week visitors as compared to previous years from there. So that seems to be slightly more positive, especially when domestic tourism is likely to actually increase compared to, say, overseas tourism by Chinese tourists from there. We would say that, and of course, there's been a lot of strong interest from investors looking in terms of safe haven trades, quality stocks, as well as gold as a potential way to actually explore from there. So these are the areas that we have been looking at quite carefully. And hopefully, we are all prepared for all possible scenarios ahead.
All right. Some amazing insights today, Kenneth. Thank you so much.
Thank you so much. Have a great day ahead.
Thank you. That was Kenneth Goh, Director of Private Wealth Management at UOB Kay Hian. This has been Market View with me, Nadiah Koh, on Money FM 89.3.
Before acting on the information on Money FM, Please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3.